Welcome back to The Explainer. Today, we're diving into a massive paradox tucked away inside Dick's Sporting Goods' latest earnings report. And we're going to uncover the real story behind their numbers. If you follow athletic retail at all, you already know this report completely blindsided Wall Street. I mean, it sent the stock tumbling by 13%. So today, we're playing financial detectives. We're going straight to the source material, step by step, and letting the data solve this mystery for us. Let's get into it.
All right, let's kick things off with a number that would normally have investors popping champagne. A massive 53.2% surge in revenue. Dick's brought in a whopping $5.59 billion in Q2. Just to put that into perspective, they did $3.65 billion last year. That is nearly $2 billion extra dollars of revenue in a single quarter. On the surface, you're thinking, wow, this is exactly what you want to see. Bigger footprint, huge sales, super strong consumer demand. You might even be thinking it's time to just blindly buy the dip. Well, hold on a second, because right underneath that incredible top-line growth is an absolute gut punch, a 25.7% drop in GAAP earnings per share. EPS went from $4.71 down to $3.50. Even their adjusted EPS fell by over 19%. And that sudden, jarring contradiction, that is exactly what triggered that brutal 13% stock crash we saw in pre-market trading. So here is the multi-million-dollar mystery we need to solve today. How on earth can a company sell 53% more merchandise but somehow earn 26% less? That's the question we're going to carry through this entire explainer. Are they just temporarily absorbing the costs of a massive expansion, or is something structurally breaking down inside the athletic retail market? Let's peel back the next layer. To figure this out, we've got to talk about the Foot Locker factor, that $2.5 billion acquisition Dick's made back in September 2025. This is the massive variable that changes the entire equation. Look, Dick's didn't just magically make their existing stores 53% more productive out of thin air. They basically bought a giant new revenue stream. The legacy Dick's business generated about $3.85 billion, while the newly acquired Foot Locker brought in over $1.73 billion this quarter. It's kind of like buying a massive fixer-upper house. Sure, you have way more square footage to show off to your friends, but suddenly your heating bill just went through the roof. Simply being a larger company is not automatically the same thing as being a more profitable company. And this right here brilliantly illustrates the internal tug-of-war happening inside the company right now. The legacy Dick's business, it's actually incredibly healthy. Their comparable sales grew at 4.9%, which was driven by higher average tickets, more transactions, and a nice little boost from the FIFA World Cup. But on the flip side, Foot Locker's pro forma comparable sales are actually shrinking by 3.6%. This tells us a lot. The core Dick's customer isn't abandoning them at all. The weakness is highly concentrated inside that new Foot Locker segment. Since we know the core Dick's customer is still showing up and spending money, we need to stop obsessing over top-line sales and actually follow the profit. Guys, this is the real shocker. The margin collapse. Operating margins plummeted from 12.4% last year down to just 7.9% this year. That is an enormous 451 basis point drop. To put that in plain English, for every $100 of gear they sell, they used to pocket about $12.40 in operating profit. Now, barely $8. They are doing significantly more work for significantly less reward on every single dollar of sales. And a huge chunk of that margin drag points directly to the new acquisition. The Foot Locker segment posted an operating loss of almost $32 million this quarter. Management came out and said this is happening amid a really difficult, highly promotional athletic footwear market. They're dealing with legacy silhouettes and a heavy dependence on retro shoe launches that just aren't hitting like they used to. You know how it goes. When retailers get stuck with excess inventory in a tough market, they have to run massive promotions and discounts just to clear the shelves, and that completely destroys their margins. Okay, so that brings us to the billion-dollar question. Did Dick's just hit a temporary speed bump in the footwear product cycle, or did they acquire a fundamentally structurally weaker business model? This is exactly what Wall Street is aggressively fighting over right now. Because if it's just a temporary blip, Dick's has massive upside once things normalize. But if it's structural, they just paid $2.5 billion for a business that might constantly act as a drain on their profitability. Well, management kind of tipped their hand here, and it's not great news. They went ahead and cut their full-year guidance. Now, expected revenue was only trimmed a little bit, but look at the GAAP EPS, slashed by nearly 17.6%, dropping the range from around $13 to $14 all the way down to roughly $11 to $12.
Operating income expectations took a heavy hit too. Management is effectively admitting to us, yeah, the profitability of our future sales is going to be significantly worse than we originally modeled.
Now, with earnings taking a hit, some folks are clinging to what we call the dividend defense as a safety net. But is it actually enough to protect you? Let's look at the return profile. The company recently declared a $1.25 quarterly dividend. That's a really solid $5 annualized return. Plus, they've got a massive $3 billion share repurchase authorization in place. So make no mistake, this isn't some speculative startup. This company generates real cash. But remember, the golden rule of investing: dividends do not protect you from a falling valuation, and they won't save you from severe earnings compression. A dividend is a really nice bonus, but it's not going to save a stock if the underlying business model is actively deteriorating. And that sets up this fierce tug of war on Wall Street right now. The bulls look at this and see a massive turnaround opportunity. They're focusing on that super strong 4.9% core growth, knowing that if Foot Locker's margins recover even just a little bit, the operating leverage will cause earnings to absolutely explode upward. But the bears? They see a company that just bought a ton of complexity, a bunch of excess inventory, and a nasty promotional environment, and they're pointing straight at that 25.7% EPS drop as proof. So, how do we actually cut through all this noise? Let's pull up the investor scorecard. These are the 5 specific metrics you absolutely need to track over the next few quarters. Number 1, you've got to watch Foot Locker's comparable sales. We need to see that negative 3.6% start heading towards zero and eventually turn positive. Number 2, the overall operating margin has to stabilize and pull up from its current 7.9% low. Number 3, EPS needs to flatline and stop dropping year over year. Number 4, Foot Locker's operating income absolutely must turn green. They have to stop bleeding cash in that segment. And finally, number 5, keep an eye out for management raising guidance again. That's your signal that the worst is officially in the rearview mirror. All right, taking all this data and evidence into account, here is our final verdict for this earnings investigation.
We're calling this a watch or conditional buy. And here's why. The core DICKS business is honestly crushing it. It's incredibly healthy. But they have got to prove they can fix Foot Locker and turn it from a margin drag into a high-powered earnings engine before you can just blindly buy this stock. If those 5 scorecard metrics we just went over start moving in the right direction, this 13% dip is going to look like a massive overreaction in hindsight. But if the footwear market stays promotional, it could very quickly turn into a painful value trap. So, as we wrap up this explainer, I want to leave you with this final thought to chew on. Is the market severely overreacting to some temporary integration pains, giving astute investors a golden entry point? Or are they sniffing out a multi-year structural problem regarding footwear margins way before the rest of the crowd catches on? Keep your eyes on those 5 scorecard metrics, let the data guide you, and we'll see you next time.